Imagine walking into your local bank and saying, "I'd like to move my savings into Bitcoin." The banker smiles, maybe even chuckles politely, but inside, alarms start ringing. Because what you just said isn't about investment, it's about control. Today, we're pulling back the curtain on the Bitcoin secrets banks don't want you to discover. You'll see how the traditional banking system quietly tries to keep you inside its walls, even as it builds hidden doors inside Bitcoin itself. You'll learn what banks really fear about decentralized money and how they're already trying to profit from it behind the scenes. By the end, you won't just understand how Bitcoin challenges banks. You'll understand how banks are trying to challenge Bitcoin right back. And before we go any further, this is educational content, not financial advice. Here's where we're headed today. First, we'll talk about why banks are inherently uneasy about Bitcoin, what it threatens, and what they're trying to protect. Then, we'll uncover 4 major secrets: the custody illusion, how banks plan to hold your Bitcoin while keeping control of it; the de-risking game, how regulators and banks quietly choke off crypto access; the regulatory whiplash, constant rule changes that confuse the public while favoring insiders; and finally, how banks want your Bitcoin, not to destroy it, but to monetize it. We'll bust myths, reveal uncomfortable truths, and close with what you can actually do to navigate this whole thing safely. Alright, let's get into it. Why banks are uneasy about Bitcoin. Banks exist for one main reason. People need a trusted middleman, someone to hold money, verify transactions, and manage credit. But Bitcoin replaces the middleman with math. It lets anyone, anywhere, store and send value without permission. And that, right there, is an extinction level event for the way banks have operated for centuries. See, banks profit by controlling flows. They make money on the spread, the difference between what they pay you in interest and what they charge in loans. They also live off fees, credit card fees, wire fees, foreign exchange fees. Bitcoin cuts straight through that. When you send Bitcoin, there's no Visa fee, no float, no delay, no permission slip from anyone. And to a bank, that's not innovation, that's a leak in their profit pipe. And this isn't new. When checking accounts first came out, banks resisted. When ATMs arrived, they fought them. Online banking, same story. They always said it was about security. It was really about protecting control. Bitcoin is just the latest round, only this time it's global, unstoppable, and open source. Later in this video, we'll look at how banks are now pretending to embrace Bitcoin, but on their terms. First, we need to talk about custody. Secret number 1, the custody illusion. Let's start with the word banks love the most: custody. In traditional finance, custody means safekeeping, holding assets for clients. In crypto, it means something much simpler: holding the private keys. If you don't hold the keys, you don't own the Bitcoin. You own an IOU. In 2025, the U.S. Office of the Comptroller of the Currency, the OCC, clarified in Interpretive Letter 1184 that national banks are allowed to custody digital assets like Bitcoin. Sounds forward-thinking, right? But read between the lines. That means banks can now legally hold your Bitcoin for you. And the moment they do, you no longer truly control it. This is the vault illusion. They tell you, we'll keep it safe. And sure, it's insured, it's regulated, it's monitored, but behind that promise are custody contracts written in microscopic print. Withdrawal restrictions, service freezes, even legal authority to halt transactions if regulators intervene. Some even lend out client Bitcoin to earn yield, the same way they lend out your cash deposits. That's called rehypothecation. It means your Bitcoin could be sitting in 10 different balance sheets at once, earning profit for the bank, not for you. Bitcoin was invented to end that system, not rebuild it in digital disguise. Here's the paradox. Banks call custody a bridge to safety, but what they're building is a bridge back to dependency. Control the keys, control the asset. That's the rule of Bitcoin, and the one thing banks can't stand. Because if customers start holding their own Bitcoin, no middleman, no fees, no float, the banking model itself starts to wobble. That's why they're racing to redefine what safe custody means. It's not safety, It's containment. If you're learning something valuable here, hit subscribe and turn on notifications. I drop deep dive breakdowns like this every week, so you don't get blindsided by what's really happening behind the financial curtain. All right, let's move to the next secret, de-risking. Secret number 2, de-risking and Operation Chokepoint 2.0. Ever notice how hard it is for crypto companies to keep bank accounts? That's not bad luck, that's de-risking. De-risking is when banks cut off entire industries they think are too risky. It's a compliance move that doubles as quiet censorship. Crypto has been one of the de-risking main targets for years. Banks say,
"We're not banning crypto, we're just being cautious."
but when every major bank does it, the result is the same. Companies can't get accounts. Payroll freezes, on-ramps vanish. It's like saying, you can play the game, but we took away the ball. This isn't new. Back in the 2010s, the government ran something called Operation Chokepoint. Regulators pressured banks to drop clients in risky industries. Payday lending, adult entertainment, firearms. There was no law passed, just informal guidance and quiet pressure. Now, crypto has felt the same treatment, unofficially called Chokepoint 2.0. In 2023, when Silvergate and Signature Bank collapsed, both key crypto-friendly institutions, the effect was catastrophic for the industry. Payment rails froze overnight, stablecoin issuers scrambled, startups lost accounts and weeks of access. Then something funny happened. While small crypto firms were locked out, big institutions, JP Morgan, BNY Mellon, stepped in and quietly began building their own crypto divisions. That is de-risking in action. Choke out the independents, then absorb their market once the coast is clear. It's a control tactic disguised as risk management. And the goal isn't to stop crypto, it's to filter who gets to play. Coming up, we'll talk about how the rules themselves are written to favor these same players. It's called regulatory whiplash, and it's one of the most effective tools banks have for keeping power. Secret number 3, regulatory whiplash. If you've ever tried to follow crypto regulation, you know it feels like quicksand. Every month, a new rule, a new agency, a new contradiction. To the public, it looks like chaos, and to insiders, it's a moat. Because when the rules are constantly shifting, only the biggest institutions can afford to keep up. Here's what's happening in 2025. The Federal Reserve just withdrew a policy that forced banks to ask permission before touching crypto. Now they can dive in first and ask for forgiveness later. The FDIC said banks can hold digital assets as long as it's done in a safe and sound manner. And the OCC reaffirmed that banks can custody crypto under supervision. These look like small policy memos, but they're not. They're green lights buried in bureaucratic language. While the public debates whether Bitcoin should be regulated, the regulators are already quietly integrating it under their terms. For small startups, this whiplash is deadly. One day you're compliant, and the next you're not. You can't hire lawyers fast enough. But banks, they thrive on regulatory chaos. They've got compliance armies, they've got direct lines to the people writing the rules. So the same uncertainty that cripples new players becomes the moat that protects the old ones. That is regulatory whiplash, control through confusion. And it's setting the stage for the next phase, where banks stop fighting Bitcoin and start monetizing it. Secret number 4, banks want your Bitcoin. Let's get real. Banks don't hate Bitcoin anymore. They want it. They just want it on their balance sheets. They want to offer Bitcoin yield products. They want to lend against Bitcoin collateral. They want to tokenize deposits, wrap Bitcoin in derivatives, and treat it under their supervision. They've realized something powerful. If you can't kill Bitcoin, financialize it. Picture this. You deposit Bitcoin into your regulated crypto account. The bank pays you 2% interest. Sounds great, right? But that interest doesn't come from magic. It comes from lending your Bitcoin out using it for leverage. If that sounds familiar, it's because it's exactly what caused financial crises in the past. That's not decentralized finance. That's centralized risk with a new label. Banks will say,
"We're bringing stability to crypto."
In reality, they're bringing crypto into their risk model. Fractional reserve, collateralization, counterparty exposure, all the same mechanics that Bitcoin was designed to avoid. And once enough Bitcoin sits inside banks, it can be regulated, frozen, or hypothecated just like cash. That's the long game. Absorb Bitcoin into the existing system until it stops being revolutionary and starts being another product line. Now, I'm not saying this is evil, it's just predictable. Banks are profit machines. They follow incentives, and Bitcoin is the biggest incentive shift of our generation. The question isn't whether banks will adopt it. The question is, on whose terms? Let's clean up a few myths. Myth 1. Banks can't hold Bitcoin, it's too risky. That's not true. They already do, under custodial structures and derivative products. Myth 2. Bitcoin will destroy banks overnight. Also not true. Banks will evolve slowly and co-opt the parts that make them money. Myth 3. Regulation kills Bitcoin. Wrong again. Regulation shapes Bitcoin's path to adoption. It determines whether it stays peer-to-peer or becomes Wall Street's new favorite toy. And here's the biggest mistake individuals make: trusting the illusion of custody without understanding who really holds the keys. If you're using a bank-branded Bitcoin account, read the fine print. Ask if withdrawals are instant. Ask if coins are commingled. Ask what happens if they go insolvent. Bitcoin doesn't punish curiosity, ignorance does. So what should you actually do? Step 1. Learn how to use a non-custodial wallet. That means you can control your keys, not an app, not a bank. Step 2. Understand counterparty risk. If someone else holds your Bitcoin, you hold their promise. Step 3. Stay informed. Follow actual regulatory updates, not social media rumors. Watch what the OCC, FDIC, and Federal Reserve publish, not what influencers interpret. Step 4. Start small. Move a small amount of Bitcoin to self-custody. Feel what real ownership feels like, because the moment you send and receive Bitcoin without permission, you understand why banks are nervous. That moment, that tiny transaction, is financial independence in practice. Let's recap. We started with why banks are uneasy, because Bitcoin challenges their monopoly on control. Then we revealed the custody illusion, how banks re-centralize your Bitcoin by holding your keys. We talked about de-risking, the quiet chokehold that limits competition. We covered regulatory whiplash, chaos for the public, coordination for insiders. And we saw how banks want your Bitcoin not to destroy it, but to turn it into their profit engine. So here's the truth. Bitcoin isn't anti-bank, it's post-bank. It's the next chapter in financial history, one that hands sovereignty back to the individual. The question isn't whether banks will adapt. They already are. The question is whether you will. If this breakdown helped you see things more clearly, hit subscribe and like this video. It helps more people understand what's really happening behind the headlines. And when you're done here, check out our next deep dive, because in this game, knowledge is your only defense. Thanks for watching. I'm Josh from Smash Crypto Zone. Stay sharp, stay sovereign, and I'll see you in the next one.